before I begin, I thought it might be useful just to recap a little bit for those of us who might not have attended previous webinars. So this is the third of a series of three webinars that we've recently done. Charles Golding was the guest on the first webinar a few weeks ago. That was entitled Key Findings of Latest RICS DCF Guidance Paper. And Charles, I think the key message that I took from that was the RSS are calling for a much more analytical approach to valuation work, and DCF is seen as very much a fundamental part of that new way of thinking. So that was a really interesting webinar with Charles from RICS. Then, was it last week, we had Matthew Dickler, a partner with Knight Frank, who came along as a valuer out in industry. We looked at practices there and his thoughts on the use of DCF. The webinar there, the title was Using DCF for Red Book Valuations, a discussion with a professional valuer. There we looked at the traditional methods of valuation and how they compare to the DCF approach, and also considered the challenges to the greater or wider use of DCF by valuers. And I think the clear message that came from those two webinars was that for chartered surveyors, there's a clear need for upskilling and training. RSS have provided that, but clearly there's opportunity to provide more training for chartered surveyors. So interesting times in that sense. So today, as a follow-on to those first two, to develop the conversation a little bit further, I thought in terms of looking at DCF, in my mind, when I look at DCF in the context of looking at it for investment value, investment worth, I think of 5 key variables: market rent, or as I still incorrectly, I was corrected by Matthew there, I still refer to ERV, market rent, rental growth, exit yield, hurdle rate, and then for the 5th variable, because it's investment worth, purchase price. Those can have a significant effect if they shift in any particular way in the models. And the one variable I thought we'd focus on then of those 5 today is hurdle rate. It's one of those variables that can have a significant impact on the appraisal itself. So information there about my profile, because I've been moderating before, I won't go back over that again. But Colin, if I could ask you, would you mind just taking us through your profile and telling us a little bit about your background, please?
Yeah, sure. Thanks, David. And thanks very much for inviting me, Sonia and David. So I'm Colin Lizieri. I was, until last autumn, a Grosvenor Professor of Real Estate Finance at the University of Cambridge. Cambridge has a compulsory retirement age, so I've been promoted to Emeritus Professor of Real Estate Finance. I've taught and worked in commercial real estate since the 1980s. By training, I'm an economist geographer, but I've specialized in finance, focusing mainly on commercial real estate, on office markets, on big city markets. And as part of that, because I've largely been teaching to real estate students, I really think it's important to maintain professional links and professional practice. I've also done quite extensive consultancy work, worked as expert witness, including in some of these areas. So even in the residential work I've been doing on leasehold enfranchisement, a lot of that rests around these whole issues about discount rates. So it's very central to the research that I've been doing and the practical business professional side of my work as well.
Great. Thank you very much. I should also add that for anybody with questions today, please jump in at any point. You can use the chat box and Sonia and I will watch out for those and look to respond to them as they pop up. So just getting back to basics about hurdle rates. What are hurdle rates? I still, in my mind, think of hurdle rates for investment appraisals, investment worth, investment value on that basis. So it's really looking at the rate of return that an investor requires. A hurdle rate reflects elements of risk that the investor is prepared to accept. And it is common practice to build up a hurdle rate or target rate of return based on a combination of specific risk associated with the property that is being looked at, and systematic risk from the wider markets. The systematic risk is a form of risk that we can't directly affect in terms of diversification. It can take the form of political risk, and we know that here, if we were to look at later in the slides, we consider the West End office market in London, and so we're kind of thinking, what are the sort of systematic risks that are currently impacting on wider market sentiment. So those are sort of factors that are brought into the mix when looking at what the hurdle rate should be. And we see there that in the, what is it, the fifth bullet point down, hurdle rate equals risk-free rate, which is commonly we look at the 10-year government bonds rate as a comparison, and then factor in additional risk on top of that in the form of, as I say, specific and systematic risk. Colin here, along with Professor Norman Hutchinson from Aberdeen, University of Aberdeen, and Brian McGregor, Professor Brian McGregor, also of University of Aberdeen, produced back in 2017 a paper which is really interesting. Other contributors to that paper were Nick Mansley from University of Cambridge, Rachel Portlock, consultant, Dr. Rainier Schultz of University of Aberdeen, and Dr. Yuan Xiao, pardon my pronunciation, of University of Aberdeen. That paper, I attended a presentation that Colin gave at Grosvenor's headquarters back in 2017. I found the paper fascinating. Its outputs, but also the interaction with the audience. It was a very large room, filled room of interested parties, various forms of investors, and it was just interesting. The Q&A afterwards, I thought, was fascinating. There's one or two people here who I know, I recognize, who was at Bill. I think you're here as well. I think I vaguely recall you were present at that presentation as well. So it was a really interesting report that was produced. It focused on what is the hurdle rate and how it's used in DCF, minimum or required rate of return, how it's applied to reflect investors' weighted average cost of capital. Key findings of that report: it is common practice. This really struck me, actually, these three key findings that I took from the report. A common practice for investors in the UK to not necessarily use DCF. Other forms of decision making include payback, profit on cost, and, as we know from the previous webinars, the traditional methods of valuation, terminal reversion, hardcore method, and so on. There is in my naivety, I thought DCF was much more present or prevalent in market practice here in the UK or in London, but seemingly not. There is significant evidence of discretionary behaviour being exhibited by real estate investors in the measurement process, which in itself has led to, in terms of market practice, inconsistency in the use of certain metrics in the decision-making process. And there's then, and this is, I held a slide over the first and second webinars where I listed 7 points of suggestions as to why there may be challenges to the adoption of DCF, but there seems to be a general reticence about adopting more sophisticated quantitative modeling applications that are out there in the marketplace. Out of curiosity, I mean, that report was back in 2017. Colin, do you still think, or has the market moved since 2017? A lot has happened since then, but would you still think that these findings still have a place for discussion?
I think that they would largely still hold. I haven't noticed any sudden sea change in the adoption of financial models, and there are good institutional and structural reasons why that's the case as well. I mean, one of the things that came out of the discussion at Grosvenor was a justification for some of the processes taken. I didn't buy all of those justifications, but you could see some of them. I mean, for example, you've talked quite a lot about specific risk. But if we took a pure corporate finance process, you'd say, well, you can diversify away specific risks. So why are you even looking at that? Whereas in practice, if you think about most real estate investors, they've got comparatively small portfolios, in which case they are exposed to a lot of specific risk, which they simply can't diversify away. So they are going to look in great detail at the individual risk factors that might affect a particular property. So in that sense, there is some justification about it. And then again, on the private equity side, the standard models of corporate finance don't necessarily fit very well. And because many of the clients of private equity funds do think in terms of equity multiples, then it's understandable that your analysis is going to lean towards what your clients are expecting. So I wouldn't have thought they're doing a great deal of movement there. The other aspect is a behavioral aspect. I mean, one of the things that we always say is that real estate is a people industry. And one of the consequences of that is that individuals have a very, very strong say in the way that analysis is carried out and the way that decisions are carried out. I think one of the really striking things from the hurdle rate project, from the interviews in the hurdle rate project, which Nick and Rachel did most of them, but we all did some, was how very frequently you would find an investment committee where a senior individual in that investment committee would look at the numbers and go, nah, and simply would
And put them
override
aside.
what the quantitative decision was taken,
Yeah,
either
yeah.
because they felt the deal smelt right, or because they had, possibly with really good justification, some qualms about a particular capital investment project, which they felt it wasn't quite right. And so even though the numbers looked all right, they exercised caution. But it was more the other way. It was more overriding a no decision to turn it into a yes decision.
Yes. And I find that really fascinating, because if you think of the holding period being typically 10 years, it's that decision as to why it goes from a no to a yay. And then you look back in 10 years' time and consider, what was that the right decision? Where is the evidence to support that? And when it doesn't work out the way you perhaps wanted it to. And that's where I think the use of DCF and that depth of analysis can at least show a logic and support the reasoning behind. But then, as you say, certain individuals can then overrule that, and it's their behaviors as to what's behind that is intriguing. Just moving on, then, I did mention earlier that in terms of how one might approach the construction of the hurdle rate, I've suggested we look at the West End office market, just because it's a very prime special market, I guess you could say, is the most where yields are arguably for offices more compressed than in other markets. All the best in class type properties and are there in London. You've helped me construct a hurdle rate approach and logic. Could you talk me through the slide here, Colin?
Okay, I think just as a clarification, we need to separate out investment value from market value here. And in preparing this slide, in a sense, I was sort of thinking about what the task of a valuer would be if they were doing a market valuation using a DCF approach. And if they're using a DCF approach, then they've got to have a discount rate. And discount rate, in that sense, we're using hurdle rate as a synonym for that. So if you're the valuer doing a market appraisal, what you've got to do is you've got to second guess all the other investors in the marketplace who are bidding or not bidding for particular properties in the marketplace. And they should be, according to finance theory, they should be using something related to their cost of capital. So the required return that their equity holders demand, plus if they're leveraging the investment, the cost of debt, plus any adjustments for the tax benefits of using debt. And it will vary depending on the investors. But the actual market price that you achieve will depend on the marginal investor, the one who actually puts the bid in that wins the prize, or if they overpay, the opposite of a prize, they get the winner's curse.
Yeah, yeah.
So what I'm trying to suggest here is, okay, well, if you were a valuer, what would you expect the sorts of returns that people were using as their discount rate. So what we've got here then is we've got historic data. Things change, but let's look historic. So this is MSCI IPD data going back as far as you can get. So over a sort of 43-year period, West End offices have delivered a return of just shy of 9%. And over that same period, the 10-year gilt, as our proxy for the risk-free rate, has been around about 5.2%. So the delivered risk premium is 3.7%. So that's what West End has delivered over government bond yields over that long period. So we then say, okay, well, what's the current risk-free rate? When we were doing these slides, it was about 4%, which would give you an implied real return of 7.8%.
Mm-hmm.
So saying, okay, well, we would expect, unless anything dramatic has changed, that West End offices, we would expect them to deliver around about 7.8%. And so if we assume that everyone else in the market has got much the same sort of assumptions as we've got, then as a valuer, we might use that as our discount rate. If you were an investor doing an investment appraisal, then you're going to have a different thought process, which is about what do we have to deliver to our stakeholders?
Yeah.
So if you're a listed company, you've got to deliver returns to your shareholders. If you're a private equity fund, you've got to deliver the returns that you've promised to your investors. You've got to get to your preference rate, so you start making additional fees over and above the management fee. So you've got a different set of targets, but those will vary from investor to investor. So what will drop out will be some sort of weighted average of all the different discount rates that individual investors should be using if they were conforming to market practice. And then the other question is, well, what's in that risk premium? And in that risk premium, again, going from finance theory, well, we've got volatility. How volatile are West End returns relative to government gilt yields? And the volatility will largely be in how the cap rate, how the yields are moving around, because the rental income is going to be relatively stable, which is why the risk premium will be lower than in the equity market. But the capital values will move around depending on where we are in the cycle and so on. There'll be liquidity issues. Is it more or less liquid than government bond yields? Well, it's less liquid because you can always buy and sell a government bond, but there might be situations in the market where it's difficult to offload a West End office, but West End offices will be more liquid than, I don't know, Newcastle shopping centres, just to grab something at random. And then other risks related to the fact that it's a real asset, so you've got to manage it. So you've got depreciation, you've got obsolescence, you've got locational risk. Will the West End be a less favoured location? We've seen recently, demand shifting out of the West End towards the city, which sort of goes against some of the previous trends. We can talk about sort of international locational risk. So these are all systematic factors which affect all of the West End market and should lead investors to demand a higher return than they would get on the government bond yield. And then that then leads to the question of, do you then adjust that required return, that discount rate, for the individual property characteristics? A pure finance approach would say no, because you can diversify them in your portfolio. But practically, given that most people will have a relatively small number of West End properties in their portfolio, then they probably are going to be concerned about whether there are individual risks to do with the quality of the building, the tenants in the building and their covenant strength, whether the leases are due to expire and that will give you reletting risk, particular building characteristics. is it, is it BREEAM excellent, or is it BREEAM appalling, and you're not going to be able to let it out if you don't retrofit it? And how much will the retrofit cost? So you're going to have to think about those individual issues, either explicitly in a DCF, so you put your retrofitting costs in, or implicitly by increasing the risk premium to account for the fact it's a stranded asset, and so on.
That's thank you very much. Can I just ask, if I look at reports from Savills, and I'm just trying to think of questions that some in the audience might be thinking, you will see prime yields being suggested for the West End has its own submarkets, even so, say Mayfair, but you'll see reference to 4%, 4.5% sort of prime yields. How does that then compare to the figures we're suggesting here?
Well, this is discount rate. So in an explicit DCF, you would take your, we're not allowed to call it ERV.
Yeah,
it's
that was something.
Yeah, you'll take your market rent. I mean, you take your market rent and whatever the rent passing is. We're allowed to use rent passing, whatever the tenant is currently paying. And then we would have our cash flows. But of course, what will happen is when we get to a rent review, we're expecting that there will be a rent increase. So we're going to have to take into account rental growth.
Yeah, yeah.
And so the yield, the cap rate that's in the marketplace will reflect the required return of investors plus their expectations of rental growth. So if we're looking at yields of 4.5%, then crudely that implies that investors are expecting 3.3% rental growth over the long run.
Yeah.
Remembering that that's a long run rental growth, not what rents are going to grow at over the next 1 year or 2 years, but where the rent, how much the rents are going to grow in the long run.
Yeah, and there's a really interesting story around rental growth in the West End, and how the stories I'm picking up are that there doesn't seem to be a ceiling on what companies will pay to have a presence there if the EPC rating is really high, because that's what they're looking for, and there's very limited supply of that. So it's very hard to form a forecast in terms of where you see rental growth and factoring that into your calculations over the next 10 years for the West End at the moment. There's a lot of turbulence, I guess, in terms of changing work patterns and requirements. And even as you say, there's now suggestions that the city is drawing more interest than the West End, which is an odd sort of development. So yeah, interesting times in that sense.
Yeah,
Thank you.
well, I think our next slide actually sort of talks to this a little bit, doesn't it?
Yeah.
I mean, one of the things I always find really interesting about this is the anticipated rental growth. If you talk to people in the market, they have generally much higher expectations about rental growth than history suggests that commercial real estate delivers. So again, I've looked at that same 1980 to 2023 period, looking at West End, and we know that because there were planning restrictions in the West End, we know that there was very strong rental growth because West End rents were higher than City of London rents. But if you look at it over the whole of the period, then market rents have grown at around about 3.33% per annum. And inflation has averaged over 4%. So actually, in real terms, taking out the inflationary increase, we've actually seen negative growth in real rents. Now, you've got you've got 3 big downturns there, at least 3 big downturns in there. So it depends a little bit on where you are in the cycle. But if you then say, okay, well, that's the long run rental growth, then what's the current inflation expectations? And the current inflation expectations, if we believe the Bank of England numbers, which are on the backs of the bond market, is that we're going to get inflation over 10 years of around about 3%. That would imply rental growth of 2.4%. Take that 7.8% required return from the previous slide and that would suggest that yields should be around about 5 and a bit percent.
Hmm.
Equivalent yield on MSCI for the end of 2023 was 5.2%. So that's broadly
In line.
consistent with that.
Mm-hmm.
But as you say, a lot of the agents are saying, well, prime yields in the West End are 4, 4.2, 4.5, depends on who you read.
Mm.
So what that implies is that prime yields aren't the yields that you would get for the typical property that's held by somebody providing data for MSCI.
Yeah.
And I think that's really talking to that separation of Class A, Class B, Class C property, prime and secondary property as a result of environment, but also as a result of changing working practices. That presents a real challenge to the valuer doing a market value.
Yeah.
And it
Yeah.
presents a real challenge for investors trying to work out what the correct price to pay is for a particular asset.
There's also a further dimension to it, and it's partly the unique nature of the West End market. You do get a lot of very wealthy investors, as opposed to institutional high net worth individuals who will come in, and it's that trophy type investment. They just want to park their money somewhere safe as well, that they're not necessarily analyzing it in the way that an institutional type investor might, and they're competing with them. And in some cases, I suppose there's an element of ego. They will pay over the odds to secure. I've seen it with, when I was working in Dublin as a surveyor, that there were some very aggressive buying approaches, let's say, that seemed to buy beyond the market in anticipation of growth in the future. But their whole approach seemed very out of kilter with the kind of rational approach that we're talking about here. So that juxtaposition between the 5.2 and the 4, 4.5, perhaps there's an element of behaviors coming into play among some of the investors, and the particular type of investor that is drawn to the West End is perhaps something unique to that market. So yeah, thank you. Very interesting. Thinking about structural change, you've highlighted some points there. And you've touched on how work practices have changed. I know from previous webinars I've done where I've looked at other capital cities, there's a reoccurring trend I was sensing where post-lockdown, occupiers who held office space out in the suburbs have been reviewing their commitments to those large spaces, and for the same money, offloading them where they can, and then taking smaller space in more prestigious locations in the central business district, because they don't need the same amount of space. And there is that whole war on talent where they're trying to attract talent to work with them, and so they want really attractive offices with high EPC ratings.
Yeah, I think that's right, and I would be more of an optimist about city centres than perhaps a lot of the literature, the professional literature, was saying in the midst of and in the immediate aftermath of the pandemic. I think there is possibly two things I think I would want to pull out of that. I mean, one is that separation. So if you are going to attract Gen Z talent to your offices, then you're going to have to offer different things to a conventional, here's an office, here's a room. You're going to have to offer them facilities. And so that's going to put a premium on much more flexible space. So some buildings will be much better suited to being in that city centre than attracting investors, attracting tenants, generating the cash flow and others will simply not be suited, and they'll become stranded assets. And that will include the ESG components, but also the actual flexibility or ability to create whatever Gen Z currently wants. So if you, will you be able to build a climbing wall or a bull pit or whatever they want? And then when they stop wanting that, can you reconfigure the
repurpose? Yeah,
um,
indeed.
which also means that you're going to have to be a lot more hands-on as an asset manager. But I never really bought the idea that everyone was going to move out to the suburbs because, well, if you think about it, the most efficient location, if you're desperate to get talent who are only coming in a few days a week, is where there are public transport lines so that you can
Mm.
bring people into the middle of cities. Well, that's a very European view.
Yeah.
And I think one of the dislocations in markets, and particularly in the investment market, is that there's an American view, which is that's not the case, and city centres are dead again. So, and that I think is having an influence on investment behaviour, and certainly a number of the agents and consultants that I've spoken to are saying that finding it incredibly difficult to make a case to investors to actually buy offices because it's all beds and sheds, beds and sheds, beds and sheds, as if supply isn't going to adjust in those markets. And so it's very difficult to persuade people to buy offices, even though the economics of the better space are now looking really quite strong.
Hmm.
Because if we look in a European context, if we look in UK context, people have come back to the office.
Hmm.
They may have only come back to the office 3 days a week, 3 or 4 days a week, but they are back. And we can see occupation levels coming back quite quickly. So for the best space, the better space in city centres, I'll be quite optimistic about the cash flow, but that doesn't seem yet to be translating into um, investment interest and hence into yields.
It's a fascinating time, and I've heard the expression bifurcation in terms of best in class and the rest, and that the widening gap. So there's a lot of repurposing. There's a lot of anticipation in terms of the next 10 years needing to, as you say, retrofit and lift the ESG or the EPC qualities of buildings, and then we're seeing reference to stranded assets. So there's a lot of change happening in the market, very dynamic time.